What is the best way to value a startup for VC? Imagine you're sitting across from a venture capital investor, and they ask you, what is your startup really worth? It's a question that can make or break your funding chances. Valuing a startup isn't about a simple number. It's about understanding the potential future value and how much risk is involved. The most common way venture capitalists determine a startup's worth is through the venture capital method. This approach looks at where your company could be in the future, especially at the point of an exit like an acquisition or initial public offering. First, they estimate how much money you'll need to reach a big milestone or exit. Then, they forecast your future revenue, profit margins, and growth over the next few years. Next, they decide when that exit might happen, maybe in 3 to 5 years. They also look at similar companies to see what kind of valuation multiples they have, like how many times revenue or profit investors are paying. Using these numbers, they calculate what your startup could be worth at that future point. Once they have that future value, they work backward, discounting it to today's dollars using a high rate of return, because startups are risky investments. This gives them a pre-money valuation, which is the value before new funding, and helps determine how much ownership they will requiring in exchange for their investment. Founders should also understand other methods like the scorecard valuation method, which compares your startup to similar companies, adjusting for strengths or weaknesses. The bucket method assigns dollar values to key success factors like the quality of your idea, prototype, team, and customer relationships. For later-stage startups, the discounted cash flow method estimates the present value of expected future cash flows, but it's less reliable for early-stage companies due to high uncertainty. Market comparables are also useful. This method looks at recent deals or valuation multiples from similar startups to see what the market is willing to pay. Combining these methods gives a clearer picture and helps you negotiate better. To prepare, you should have detailed financial projections, a solid understanding of your market, and data on comparable companies. Know what kind of return investors expect and how long they plan to hold their investment. Be ready to explain your team's strengths, your product's potential, and your market opportunity beyond just numbers. Most importantly, remember that valuation is often a negotiation. Market conditions, investor appetite, and your growth potential all influence the final number. Using the venture capital method as a starting point, combined with other approaches, helps you present a realistic and attractive valuation to investors. This way, you can build trust and set the stage for successful funding discussions.